As we know, backtesting helps to validate a trading strategy, ensuring that decisions are backed by evidence rather than speculation. I am Villem from Truby Trading, and in today's episode, I will be doing a case study on backtesting to determine if the strategy is even profitable in the long run. Before we get started, let's go over the schedule for this video. Firstly, we will decide our goals for the strategy. Secondly, we will define a rule-based strategy and we will make it as mechanical as possible. Thirdly, we will decide what data we want to collect, and during that time, we will create an Excel spreadsheet. Fourthly, we will backtest the strategy manually and put all the data we gather to an Excel spreadsheet. If the strategy is backtested enough, we will deduce the final conclusions. Starting off, let's make up goals on the strategy's performance. As we are using the risk to reward ratio on profit and loss taking, let's assume we always risk 1% per trade. Therefore, the first goal is to make on yearly average 3% per month as 3R per month. In other words, it's 36% in pure performance annually. Secondly, the maximum drawdown shall not be over 10% at any times, so we assume we will not get more than 10 losing trades in a row. Thirdly, for an important strategy metric, the profit factor must be more than 1.5. For the entry signal, let's use the concept on stop hunting, and we will be taking trades only on the 5-minute time frame. The strategy will only be traded at the London and New York session, as at that time I will be awake. Therefore, we'll only backtest trades from 7 AM until 8 PM based on the New York time zone. We will only be looking at stop hunts from very specific levels. During the London session, we will only be looking for Asia session high or low to be taken out. During the New York session, we'll be looking at London sessions high or low being graded. After the trend change, the entry is placed by a limit order. The entry is from an imbalance, also known as a fair value gap or a place of single prints. Additionally, the entry must be in the discount, meaning under 50% of the initial move that broke the trend. For risk management, we'll use a fixed take profit and stop loss levels. The take profit is placed at the next intraday liquidity level or according to 2RR if there are no intraday levels present. For it to be a valid intraday liquidity level, it must be, for example, a current session's high or low, be a significant double top, or a major fractal. The take profit level can be maximum of 2.5 R away from the entry. The stop loss is placed always behind the high or low of current session's liquidity sweep. Let's go over some live examples when the strategy is being played out in the markets. Here we can see that the London session's price action took out the Asian session low. So when plotting it, we can see it's a nice liquidity grab or a stop hunt. Doesn't matter how we say it. And now we must wait for a market structure break to be bullish. So let's plot the lines. We want the market structure break to happen. And for me, it's always from the swing highs body close. So I must wait now for the price action to close above this black line. So let's go further in time. So we got the bullish trend. Now we must, according to our entry model, we must get our take profit, entry, and stop loss in place. So let's plot the Fibonacci. Here we can see that there is imbalances below the 0.5. So we must entry from the 0.5. I will also plot the imbalances that we must enter from. And also the long setup tool. The stop loss is always below the liquidity grabs wick. When it's a long setup, it must be below the price. And the take profit right now is a beautiful double top according to our take profit rules set by the strategy. Let's go further in time. We can see here that the price went to the upside, so we have to now regulate our Fibonacci and bring the entry much more higher. Let's bring the Fibonacci up, and here we can see that there is a very small imbalance that is basically the 0.618, so the 0.618 will be our entry. So let's bring our entry up, and the take profit and the stop loss will always stay the same. Now let's wait for the price to come down again. Now we got filled, even the price went little bit upper than we anticipated, but the price and entry will stay the same as it is from the 0.618. Now let's go further in time. We can see quite a huge drawdown, but we will stay in the position. We will not scale down, we will not do anything. And here we can see the take profit being hit, and that's the trade. Basically it's 1.7, so we reached 1% to make 1.7%, and they wouldn't have been stopped out with due to spreads or anything right that either. For a short scenario, we can see here that the London session's high took out the Asian session high, so we now must wait for the market structure break to be bearish. So let's go further in time. Let's also plot the market structure or trend change line, so you don't forget. And for me, it would be from that close to the body from right there. Yep, we got the trend change to be bearish, and now we must, under our entry model, we must get our entry and exit point. So let's bring out the Fibonacci. As we can see here, there is no imbalances above the 0.5. So our entry right now is from the 0.618. And the stop loss must always be above the liquidity hunt, liquidity sweep, liquidity grab. Doesn't matter how you say it when shorting. And for the take profit, there is no significant lows there, so we have to target the current session's low. Let's wait for the as the price went even more downside, we have to now regulate our entry points. So let's bring the Fibonacci even further downside, and we have to pull our setup to the 0.618 back again. And the take profit must also go now to the session's current low. Now we got the entry. Let's put it to the right place also. And now we must wait for the take profit or the stop loss to hit. And here we can see the take profit being hit. As it is an example picked by me, I wouldn't choose any losing trades. But bear in mind that the strategy has a close to 60% win rate, so losses will happen eventually, and so will drawdowns. But that's the part of business in trading. For manual backtesting, let's use TradingView and Excel. In order to start backtesting, let's create an Excel worksheet, and there we will determine what data we will collect going forward. The more the data you collect, the better. There are a few drawbacks though when collecting this data manually. With every parameter and variable you add, the longer it will take to backtest. That is why backtesting with an algorithmic bot is so beneficial and time-saving, as you can collect hundreds of data points for tens of years in a matter of minutes to hours. Nevertheless, let's start backtesting this strategy manually. Let's now build a simple backtesting journal that we can use when backtesting with TradingView. So the must-have data that we will collect is the direction of the trades. So this is either long or short. We'll also gather the result of the trade, win or loss. Then we will collect what session the trade took place in. Was it the London session? Was it the New York session? Then we will gather the data on the date of the trade. So let's say, for example, so it's the 1st of January 2024, and let's say this is a 1st of December 2023. So let's say, for organizing sake, we can also plot the month, and we can say that we'll take it from here. So this is the January, and this is the December. We can use this data later when analyzing the monthly returns, for example. Let's also plot the time the trade took place in. Let's say, for example, according to New York time zone, let's say it was from 3:05, and let's say also 3:04. So they're both London session trades. Let's also gather the risk percentage per trade. So for me, it's always 1%. So I rarely change it, but if you start to change it, then you have to have some more complex formulas also. And we have to also gather the result of the trade. So how much R we made, not percentage, how much R we made. So let's say 2R, let's say 1R. So we made 2R, so basically we made 2% when risking 1%. And the must-have is a screenshot, so we can always come back to it. And this would be a TradingView link or for example, a Kiaso screenshot link. And that's basically it. We'll now start backtesting, and we will fill all these tables, all these data points with lots of data. Let's try to get at least, so to say, the trade number very high, but making it manually is quite time consuming, quite boring sometimes, but we'll do our best, and we'll see you when we'll start analyzing this data. Let's start now by analyzing the data we gathered from backtesting the Euro-USD Forex pair. So firstly, as we can see here is more than 2 years worth of data, and it amounted to 191 trades. That's not a huge volume of data, but that's enough for this simple case study right now. So firstly, to deduce the final result of the strategy for the 2 years, let's create a new column with a cumulative R. So for the first row, we'll take just a first trade result, and for the rest of the rows, we'll take the previous, so to say, cumulative R and a current trade result. And now we'll just drop it down. And for our end result of the backtest data, we gathered that the strategy made total of 105.88 R. So in our case, it's 105% for the whole more than 2 years worth of time, so to say. Now let's also plot it on a graph to make it more visually appealing. Let's create a simple line graph. I'm gonna bring it up. So for instance, for this equity curve, we can see it is beautifully in an uptrend. We can also add some new elements to it, like a trend line. Let's bring it a moving average, and let's make a 20 period to determine the, so to say, new drawdown areas it may face. Let's also switch the line to solid. Let's put orange. So yeah, it never broke the 20 EM, so to say, moving average. That's a good indicator of a drawdown with the strategy. So it is quite decent that it didn't break it. Let's also gather some more strategy metrics we might want to use. So for example, let's create a new table. So firstly, let's see how many wins and how many losses the strategy took in the first place. So let's plot the win and loss. And for that we can use the, so to say, formula COUNTIF. And for the range it is the RR, so the results. And the criteria is that it must be more than 0. So in total we took 111 winning trades, and for the loss we have to switch the symbol to the other side, and it must be less than 0 basically. And for the loss we took 79 trades. Let's also now see what the win rate of the strategy was. So for that we can use the simple formula that just will divide and will sum the win and loss values. And for the more than 2 years worth of data on the strategy, the win rate came to a 58%. It's quite decent, as the risk to reward ratio is at most times 1.6. Let's also go over now how many R we realized and how many R we lost. So for that we can use the SUMIFs function, and for the sum range it is the RR again, and the criteria is that it must be more than 0. You can just use SUMIF. So in total we realized 184 R's, and we lost. You can just use the same, but we have to change the symbol. And we lost 79 R's. So our profit is, we can just sum them up, and then the result is 105, like we had also here. It's 105.88. Next up, to get the monthly data of the backtest, let's create a helper column. So it's just called month, and it will only get a month value of the trade, so to say. And it represents that the 1 is January, 2 is February, and so on. But there is a catch. For the 2023, so to say, trades and 2024 trades, we will now add 12 to make it unique. No, we'll add 13. Like that. No, we'll add 12. So, and now for the 2024, you can see here it starts here. It's only 1 month. It's only the January, and we'll add 24. And now all the months are unique, and we can start plotting them on a new table. And for that, let's create a new table for that. And let's also, for the first January month, let's put 2022, so we know this is 23. And here we have 24. Let's highlight so we can see that the year starts again. And now we can start to get the monthly performances. So to say, let's gather all profit. So what was the end result of the month? And average risk to reward ratio. And for the R profit per monthly basis, we can use the sum ifs function. And the sum range is the RR. So for me, it's in the way, but it's basically, hold on, it's RR, yep. And the criteria range is the month range, so it must be 1. Hold on, there is some sort of an issue. Whoop, and now it's fixed. So for the first of the January 2022, the end result was 2.9 R, so it's 2.9%. And now we can just plot the formula to the upcoming cells, but we have to change the number in them manually. So the February is 2, March is 3, and so on. Now let's just double check that the last is 25. Yep, correct. And now we can see that the monthly results vary quite a lot. And we can also get the average of the monthly basis results. And the average is 4.2, or so 4.2% per month. And now for the average RR per monthly basis, we can use the average ifs function. And for the average range, this again the RR range column. The criteria range is month. Now for the January 1st, 2022, we have to use the 1. And now criteria range is again RR, so you only take the positive trades. And we can see here the average risk to reward ratio was 1.48 for the 2022 January data. And now again, we can just plot the formulas to the upcoming cells, but we must change the number again. And now again, we can just organize the column a bit better. Let's make 2 decimals, and we can see here also that the September month didn't have any positive trades, so let's just put 0 for it. And now again, we can get the average RR per the month basis. And it doesn't represent the average risk to reward ratio per the strategy, as the months have different amount of trades in them. So it's important to keep in mind that. But now, as we have the table quite simply in place, we can gather more data. We want, for example, how many London session trades or how many trades between some times we had. But for the sake of this video, we'll keep it really simple, as the raw data we gathered is very simple. So let's create a simple graph to represent that table. And now let's change the chart type. So for the combo, how can I change it on the Mac? It's different than on a PC. But that's correct also. So let's bring the table below here so we can make it higher, bigger. And you can see here that the orange line represents the average risk reward. But September data that doesn't have any RRs messes the graph quite a bit up, so let's even remove it. And here we can see that the average risk reward ratio is always around the 150, so 1.5 and 2. It doesn't even go over the 2 at all. Never mind, it does for the November data and also for the October and September data. But overall, it's nearly below 2 at all times. And for the R profit, so that is the ending result per month, how many percentage gain it made. We can see here it does have some negative months, like in September, -4%, and also in August. But this graph, or this, so to say, chart doesn't represent the equity curve at all, as we can't determine any drawdowns based on this chart at least. And we can probably deduce that the March data and the June data is also visibly represented in the equity curve, maybe between the 88 and 110, and maybe between even the 118 and 136. So the winning, so to say, strike and flow of winning trades was best there. To conclude, let's now compare the strategy's performance metrics to the benchmarks we set in the beginning of the video. So the first benchmark was that the strategy must perform 3% profit per month and 36% annually. And the 3% per month has to be the average of the annual performance. So to say, it has to be average 3% and 36 per yearly. So let's now check the data. We can see here that it made 4.2 averagely every month, and for the whole year, let's say, so let's bring the 2022, 2023, let's not compare 2024 as it is a new year and there is no data for it except the January data. I now see that there is a mistake. Oops. So let's get the average monthly, and let's also get the yearly performance. So this is just to sum it. So 34%, and we wanted 36 yearly, so we just missed our benchmark. And for the 2023, it is 66.7. So there we, so to say, blew the benchmark apart. And for the average monthly, it is 2.8, so we didn't hit the benchmark here as well. And for the 2023, it is 5.5, so again, we blew the benchmark there again. So for the first year, we did not perform as well, but for the second year, we did. But to get the averagely, the both years combined, we did succeed with the strategy. And we can also see that the sum is 101, so let's make it to 2. It's 50.66, and it's also more than 36 yearly, so to say. So for the second benchmark we set was to not get more than 10 losing trades in a row, so we can't be more than 10% in the drawdown. Additionally, visually, we can see that the drawdowns were in the 36 to 43 range, and also just 172 and 181. So let's find them in the raw data, and let's now analyze what was the highest drawdown we encountered. So we can see here that the highest, so to say, losing streak we had was 5. So it was 5R and 5% we were down with the account, and it kinda quickly recovered. So the maximum drawdown we can see here was 5, and it was in the September and October of the 2022 year. So we also, so to say, did not go over this limit, and the benchmark was met. And for the third benchmark, we had that the profit factor must be over 1.5. And to get the profit factor, it's quite simply with a simple formula that we divide realized with lost, but we will also put the minus sign as we want a positive number. So the profit factor is 2.3. And according to the benchmark we set, it is over 1.5. So the strategy did perform very well there also. So with that, we can finally conclude that the strategy was met within the benchmarks, but not for the, so to say, 2022 yearly data according to the 3% profit making rule we established. But if you take the overall data, it didn't make it in the rules. But nevertheless, thanks for watching this video, and I hope you learned quite a lot from this case study, and it will also help you backtest your trading strategies. And always, if you like our content, subscribe to our YouTube channel and follow us on the socials linked below. See you in the next video, and good luck backtesting.